Good morning, everybody. Happy 2016. This is the live market open for Monday, January 4th, 2016, the first show of the new year. I'm Yohay Elam of Forex Crunch and Market Movers podcast, doing the show as usual for FX Street. I hope everybody had a great beginning to the new year, a great entrance to the new year. As always, we'll cover recent developments, and we had quite a start for the new year. Charts and levels of various currency charts for whoever is new here. We'll cover the next 24 hours. As usual, the most important part is your questions that you're welcome to ask in the chat box. If you cannot see the chat box under the video, please go to tlk.io/fxstreet-forex-live-video, the address that is on the screen. I'll just mention that on Wednesday we'll have a special 2016 outlook, okay? Anyway, today we'll have a regular show. All right. So on the last day of 2015, that was actually Thursday, December 31st, we had U.S. jobless claims coming out disappointing with rise to 287. Sort of bad taste to end the year in terms of jobs, which were in general quite good in 2015. But it's still within the range. It's still a fluctuation. We had over the weekend two Fed members speak. Mester, which is from the Cleveland Fed, she was hawkish. She said she wants even more than 4 hikes in 2016, but that was no surprise. She's a known hawk, but she gets to vote. Okay, she gets to vote in 2016. We also heard from Vice Chair Fisher, number 2 at the Fed, but he didn't say anything really important. Another development we had over the weekend, and we'll talk about that in the 2016 outlook as well, more in detail. We had this clash between Iran and Saudi Arabia over the execution of a Shiite cleric, and what happened afterwards is the burning down of the Saudi embassy in Tehran and the severance of diplomatic ties. And anyway, this is more geopolitical at the moment than having sort of a direct impact, but it also makes the mood worse. Now, the mood, of course, was directly worsened in financial markets by China. China was high on the agenda in 2015 and also in 2016. It remains important. The independent Chinese Caixin manufacturing PMI disappointed with 48.2 points, okay, showing sort of more contraction, more slowdown in the manufacturing sector. Now, I have an open question. Is China moving out of manufacturing and more into services, more into internal consumption, yes or no? Anyway, for Australia and for other markets, less manufacturing by China is not a good sign. In addition, in China, the devaluation of the Chinese yuan continued. Again, all the talk about currency wars and stock markets, first and foremost in China, but also elsewhere in Asia, they dropped, and also in Europe now. So in China, we had trade suspended in one index. Anyway, it's sort of a bad start for stock markets. All right. Now, let's look a bit at the chart before we move to today's events. Euro dollar is on the rise, okay? It began during the Asian session. Well, we had a small gap to the downside. We had 3 days of a long weekend, but then a rise back up. Why is the euro rising? First and foremost, risk off, okay? We talked about this during the shows in the past 3 months that the show is running, that the euro has turned into a funding currency because of the ECB's policy. All right, it became a cheap currency in which you lend it and you buy riskier assets. But when things become worse, it doesn't matter if it's bad news in the eurozone, such as the Greek crisis that we had in the summer, or now the uncertainty about Spain, or now with China. It strengthens the euro because money is repatriated, money is coming back home. Okay, this is a relatively new phenomenon for the euro. We're seeing it now at 109.18, within range 109.50, 110 are on the upside. 108.80 is sort of weak support, followed by 108. Okay, it's not a new phenomenon for the Japanese yen, and look what a strong move to begin the year, a crash of dollar yen. The strength in the yen began already last week with this risk off, and also because the Bank of Japan is seen as not willing to act, not willing to weaken the Japanese yen. Of course, at some point, if the yen is too strong, Japanese authorities might intervene, but at the moment it's risk off. That means safe haven, rush into the yen. For the yen, it has been this kind of funding currency safe haven for about a decade or so. Anyway, we're now seeing a crash of dollar yen. 118.86 is the current level. We fell below 120 overnight, sort of provided support last week, and now we're below this level. Further support, we'll have to zoom out to see where we've been at these levels before. So, well, not that long ago, but yeah, in October, some support at 118.20 and then 117.80. And in August, when we had the previous Chinese stock market crash, dollar yen fell to the 115 handle. Anyway, 120 now turns into resistance. Okay, the pound has shown signs of weakness in the last days of last weeks of 2015, and this continues now. The pound is not a safe haven currency. It began with the gap to the downside, began the year under 148. It already dipped below this level at the end of 2015, but held above in this narrow range. Boom, now we have this gap to the downside. So far, it fell down to support at, 146.90. All right, now it's a bit above this level, 147.60, but all in all, it's a gap to the downside. In the UK, we're not sure we're going to have a rate hike in 2016. The Bank of England was expected to raise rates after the Fed, but there's lots of uncertainty about that. Now, what happens when money goes into safe havens? It goes out of risk currencies. That means commodity currencies, first and foremost. Even though the price of oil is not in a terrible shape, let me look at that quickly. Yeah, 37.30, relatively stable on WTI crude oil. The Canadian dollar is weakening. The dollar CAD is on the rise, 139.34, 140. The round level remains resistance because the pair really got stuck here. Support is at the previous resistance line seen in mid-December of 137.87. Further support 136.20. But if oil prices continue falling, this could we could see dollar CAD move even higher. Now the clash between Saudi Arabia and Iran is of course supporting oil prices because there's always a danger to supply from the Middle East, from the Persian Gulf. But remember, one of the reasons for this clash is that Iran is expected to come back online. Saudi Arabia wants to make it sort of not worth Iran's while to come back online because for Iran it costs more to produce oil than for Saudi Arabia. In general, there's a price war going on in oil prices. So all in all, oil prices are pressured. If we see oil prices going up because of tensions in the Middle East, the United States will just pump out more because of the flexibility of the shale industry. Again, we'll talk about everything more in detail for 2016 in the outlook on Wednesday. Okay, let's continue with the charts. Aussie dollar, also the Australian dollar, a risk currency, falling down. It showed a relative strength late in 2015. It managed to climb above this very, very clear separator of ranges, 72.80, reached 73.20 at the dying hours of 2015, and now it's back down to 72.10. The low level for today, 71, just under 72. 72.20 is some kind of resistance at the moment, but much stronger resistance, 72.80, and real support at 71.50. Kiwi dollar had a strong finish to 2015. Remember, milk prices are going up. The economy in New Zealand is doing well, but with Chinese stock markets crashing, with worries all over the world, it's a fall back to the lower range. Risk off 67.67 current level. 67.45 is the low. I see support at 67, which is a round number. 69 is high resistance, but we're far off from that at the moment. Okay. Dollar Swiss began the week with the gap to the upside. Remember, the Swiss National Bank intervenes to weaken the Swiss franc against the euro. Good morning, Fabian. Good to see you in the new year. So the moves are sort of inverse of euro dollar. We saw the same gap towards, in this case, the upside, when euro dollar towards the downside. Now we're seeing the pair move down back again. Next week, it's the 1-year anniversary for the S&Bomb, January 15th, 2015, the date that the Swiss National Bank shocked financial markets, shocked the Forex industry by removing the cap or the floor under 120 in Euro Swiss. Euro Swiss since then has been trading, of course, much lower. 108.62 is the current level, well within the range, okay? The Swiss National Bank seems to defend this line here of 107.60. Currently, it has more space to move around. 109.50, I would say some kind of resistance. Anyway, currently we're in the middle of the range. Okay, so Euro Pound, it had a clear direction to the downside during 2015, but this thing changed with the weakening of the pound and the strengthening of the euro as a safe haven. Remember, the euro is also hit very hard, about 9% against the dollar in 2015, but it did manage to stabilize, especially as Mario Draghi disappointed markets, didn't meet his own expectations in early December 2015. Anyway, it's more about the weakness of the pound. Currently struggling with 74.10 is resistance, 73.30 is support. Euro yen, well, stronger yen is the main feature. We're down to support here, down to the previous levels seen in the December for this cross. 128.74 is support, or 75, and the resistance 130. Pound yen extending the move to the downside. The pound dollar cable gap to the downside. Dollar yen also to the downside. This results in a huge crash for pound yen. 175.30. I think 175 is support. Why is that support? Well, at first it's a very round number, but also it has worked as support early in 2015. You can see here around April and also beforehand. Let's see if we have a break below this level or we'll have a bounce. Anyway, exciting days for those trading the Dragon, the Gepi, if you wish. Okay, so I guess we've covered major currency pairs. Let's talk about events for today. So today we talked already about the Chinese manufacturing PMI. We have PMIs from everywhere. At the moment, we have final Eurozone PMIs. Let me refresh the FX trade calendar here on Forex Crunch. I have a new design for Forex Crunch. Anyway, let's focus on European currencies. I hope you're aware of these features on the FX trade calendar, which offers lots of information. We'll filter out what we want to see for today, for major countries, major areas. Yeah, I think we have them all. Yeah, let's filter the results. So we're expecting the manufacturing PMI from Spain, then from Italy, then from France. France is the final one. We already have the preliminary one, the final from Germany, and the final for the Eurozone. The initial releases from Germany and France have more impact than the final releases, but this sometimes provides excuses for bigger moves. Let's see if we see a reaction. Euro dollar currently at higher ground. We're currently at 109.25. We'll have the Spanish PMI released just in a few seconds, but remember, it's not that important. We have more important figures from Spain. More importantly, we have at 9:30 GMT, 9:30 in London, 10:30 here in the old continent, we have the manufacturing PMI from the UK. Like in many other developed countries, manufacturing is the weaker link, right? So we're expecting market manufacturing PMI. No consensus for that, but anyway, it was last time at 52.7, which was still showed growth, but not so good. We had some kind of a false move to the upside in the previous month. in October, and then in November back down. Let's see if we're still stable or we fall below 50 points, which is the level separating growth from contraction. Okay, so for those trading the falling pound, this is a critical figure. I think the pound is a bit vulnerable, and if we'll have another disappointment, and manufacturing PMI usually disappoints, then we could have another fall right here. Also in the UK, we have net lending to individuals, consumer credit, but these are more secondary figures. The manufacturing PMI always stands out. Okay. Later we have German CPI, German inflation figures. They're actually released during the morning. The numbers are released from various German states, Baden-Württemberg, Bavaria, the Berlin area. I don't remember all the 16 German states, but these numbers are released during the morning. The final figure is at 1 GMT. Okay, let's see what we're expecting here today. There are four figures, the year-over-year and month-over-month, and these figures are also available for the national figure and the harmonized one. That means the German standard and the European standard, they're usually quite similar anyway, so year-over-year figures are more important. We're expecting a rise in the harmonized and the European standard from 0.3 to 0.4, and in the national one from 0.4 to 0.6. Remember that the big fall in oil prices began last year in November with the OPEC decision not to cut production. Now these are already preliminary figures for December, and since then oil prices did fall more, but not as much as the year-over-year change. We're beginning to see the base effect move away, okay? So the excuses about energy prices causing low inflation are beginning to fade out. We're expecting to see headline inflation move back up, okay? That doesn't mean really high inflation, not even close to 2%, more closer to core inflation as we see it in the Eurozone around 1%. Anyway, these are the figures from Germany. And perhaps the most important event for today comes from the United States, the US ISM manufacturing PMI at 3 GMT. Let's see where it is right here. Yeah. So last time it fell into contraction ground under 50 points, which was bad news, but not really surprising. All the manufacturing figures from the United States have been quite negative. If you look at the Philly Fed figures, if you look at industrial output, capacity utilization, things like that. Now we're expecting a small rise from 48.6 to 49. Manufacturing is a very small part of the US economy. Like many developed countries, the focus moved to services, and China and other emerging markets manufacture stuff for us. We wear clothes from Bangladesh. China use electronics produced in Vietnam, Taiwan, and other places. So anyway, we're expecting a rise from 48.6 to 49 points. This also includes the employment component, which is the first hint for the non-farm payrolls on Friday. Of course, the big event. It's the non-farm payrolls release for December, and of course, concluding 2015, providing a hint for the next Fed decision. And then the next Fed decisions actually in January, the end of January. We're not expecting any change from the Fed, but we are expecting a change perhaps in March. So this is the first hint. Here is the countdown for the FOMC. Let me refresh this. I've shown this figure many times in the shows in recent months. This is what bond markets tell us about the next Fed hike. The next decision is on January 27th, and as you can see, an overwhelming low probability of a rate hike, only 11%. We can dismiss that. There's also no press conference. For March, there's already a majority for a rate hike from 0.50, a maximum of 0.50 to 0.75. I would say even if we look at this 1% thing, it's even around almost 60% for a rate hike, but things will change, of course, after the figures from the non-farm payrolls and as Fed members continue speaking. Okay, so this is, we have today the ISM manufacturing PMI. Okay, let's take a look at the PMI for Spain. It was released just now. Actual 53. Okay, very similar to the previous one. It was 53.1. No big surprises. Let's see if we're seeing euro-dollar move. Anyway, I don't think it. Yeah, euro-dollar continues rising. I don't think it's related to this PMI. It's more related to the risk-off atmosphere, which supports the euro and the yen against basically all the rest of the currencies. Okay, so anyway, Happy New Year, everybody. Let's talk a bit more about further events this week. We also have a preview for this week recorded on FX Street, but let's sort of go through these figures once again. So, all right, let's begin from today. What we already had from China. Markets were already on the edge, and we had a weak figure from China, the Caixin manufacturing PMI. Let's just take a look on this on the chart, on the calendar, sorry. See, 48.6 was the previous, 49 was expected, and 49 was the actual figure. It's an independent figure, not the government one, so it makes a bigger impact. Then we have today the NIC manufacturing PMI. Tomorrow we have, for those of you trading the kiwi, milk prices. Actually, it's the only event for the kiwi this week, so it has an even bigger impact. And we have inflation numbers from the Eurozone. This is important for the next ECB decision. The ECB meets on January 21st, and after disappointed last time, it might provide more stimulus this time, or at least hint of more stimulus in March, when in March they have their new forecasts, the ECB staff forecasts. So we're expecting inflation to rise in the Eurozone, but nothing is certain. Once again, the base effects are supposed to move away. Wednesday is a busy day. Wednesday we have, for the dollar, for everybody with the ADP non-farm payrolls, this private sector report from ADP, which is a big hint towards the non-farm payrolls, even if it sometimes misses the mark. Okay, and then we have the ISM non-manufacturing PMI, the services sector report. Here we have growth, we still have strong growth, and also the employment component is positive. The employment component is what's important for Friday's NFP. And Friday, of course, non-farm payrolls. Let's take a look at that figure. Let's see what we're expecting. Of course, we'll talk about it more in detail, and of course, cover it live with Valeria, Mauricio, and Dale. So US non-farm payrolls on Friday. Last time we had 211,000. This time I don't know why we don't have a consensus number. But of course, it's always important to watch not only the headline number, but also revisions, and perhaps even more importantly in recent months, the changes in wages. Okay, we finally had an advance in wages in the report for October. We had 2.5, then we had a slide back to 2.3, but all in all, the Fed does believe we're seeing initial signs of rises in salaries. Okay, we heard that from Janet Yellen in the press conference. Okay, so it's quite a busy week. The first week of the year, first week of the month, of the quarter, and so far we have a negative atmosphere in markets. Okay, let's reflect once again. I see you don't have any questions so far. Let's talk about the last big event of 2015, which still has echoes in markets. Okay, the historic rate hike by the Fed. On December 16th, the Federal Reserve in the United States raised rates for the first time since 2006. Okay, nearly a decade. It's the first change in rates since late 2008, since the financial crisis. It raised rates from a range of from a range that was 0 to 0.25 to 0.25 to 0.50. The move was successful in technical terms. The new rate, as published every day by the New York Fed, is now 0.36, 0.37, bang in the middle of this range. More important, this was well telegraphed, okay? The Fed prepared us for weeks and weeks, if not months, for a rate hike. They hesitated in September and then actually moved, and they finally made the move in December, this was not the surprise. The surprise was that they didn't change the final rate for 2016 according to the dot plot, 1.4%. That means 4 more rate hikes. Markets don't believe that. The implied probability is not for 4 rate hikes. But that was a surprise from the Fed, and that strengthened the dollar a bit. Also, the forecast didn't change too much, and there were no dissenters. Remember that the composition of the Fed, the voting members of the Fed, is different now. Okay. Before I'll talk more about the Fed, I see questions here. Good morning, everybody. Good morning, Ryan and Tillen. Happy New Year. Every quarter, you guys release a great report on the best pairs to trade. What do you suggest for the next 3 months? When does your quarterly report come out? Well, thanks for the kind words. Actually, I still haven't published that out. It should come out in the next few days. So I'll also let you know in the show, but just follow Forex Crunch. And yeah, this should be this week. Should have prepared it last week, but also I was on holiday, and I hope you guys were as well, but don't worry, it's coming out. Okay, Tillen says pound yen already 175 during the show. Oh, thank you very much, Ryan. Yeah, we talked about pound yen. It's one of the biggest movers this morning, this new year so far. Actually, it's a fall of 1.8%, as I can see here. Currently, yeah, 175.31. Part of the move happens during the show, but we already had a gap lower. What's going on? Risk-off atmosphere. Worries about Iran and Saudi Arabia. Worries about the Chinese economy from the Caixin manufacturing PMI. Worries about currency wars from China with more devaluation. Chinese stock markets crash. Safe haven flows. This results in a stronger Japanese yen, the clear, the sort of number one safe haven currency, and the pound, which has already shown signs of weakness in 2015, just extends the move. Why is the pound weaker? Why did it fall towards the end of 2015? We had a great expectation that the Bank of England, Mark Carney, will follow Janet Yellen and raise rates. I was talking about that many times, and I lost faith in this assumption because the economy in the UK is not growing as expected. One of the last figures released, I think just around Christmas, was that the UK economy is growing only 0.4 instead of 0.5. This joins a slowdown in the improvement in unemployment, the slowdown, the flattening, as the Bank of England said, in regarding wages in the UK, and in general messages from the Bank of England that they're not sure what's going on. Okay, so we had the Bank of England expected to raise rates soon, well, 3 months, 6 months tops after the Fed, and now the pricing in for UK bond markets is only to 2017. If we don't have a rate hike from the UK in this year, in the next 12 months, why invest in the pound? If also remember, the Eurozone is still in trouble. If we have less demand from the UK's main trading partner, we have less demand for the pound. If we have an in-out referendum for the UK about the participation in the European Union, more uncertainty for the pound. I believe they'll stay in, but it doesn't matter. It's all about speculation, so it doesn't look so good. Okay, more questions? Anyway, regarding regarding more predictable so far, euro dollar is respecting the lines I have on the chart. Doesn't mean it's the most predictable pair, but it does look quite good. Okay, another question from Fabian. What is making euro dollar going up so steep this morning? What will move it today? Well, what will move today is two things. Your German inflation numbers, which are released during the morning from various German states, and more importantly, the ISM manufacturing PMI in the United States. These are sort of the main indicators. But what's moving it right now? What's moving it is the safe haven flows, worries about China, money flows back, repatriation into the Eurozone, worries about Spain. Not so. I mean, we have a hung parliament here, and a good chance of fresh elections. Remember, in Spain, many people are still on holiday because there's another holiday here on January 6th, the Epiphany, and only then Spaniards come back. So politics are a bit stuck, but in general, there is a good chance of seeing fresh elections. But it's mostly about China, Iran, and Saudi Arabia. When we have troubles, this cheap funding currency of the euro that goes out of the eurozone comes back in. So far, we're not seeing an attempt to break 110, but this may come as well. So far, 0.5% higher. Just a second. Sorry about that. So regarding inflation from Germany, we already have one figure from Saxony. It's one of the German states. It came out at 0% change month over month, worse than last month, which was plus 0.1. And year over year, we have a rise of 0.2 in comparison to plus 0.4. So far, only one figure out of the German states, but it's not that positive, okay? But let's see the final figures at 1 GMT. Yeah, Happy New Year also to you. Any more questions? Anyway, for euro dollar, it's 109.50, 110, 110.70. And to the downside now, 108.80 and 108, which was strong support in December. Question, what's your bias for euro dollar from today? Still bearish? No, today, well, specifically today, I'm not bearish. In general, for the year, of course, we'll talk about that more on Wednesday when we'll have the full preview for 2016. We'll have sort of a short version of the show and a full preview. My tendency is to see another small fall in euro dollar, not a move all the way to parity in the first part of the year, and then a big bounce back higher, a big move to the upside. For main reasons are, I think we're closer to getting out of the crisis in the eurozone than many think, and even if the United States economy continues rising, these Fed rate hikes will begin, the impact of higher interest rates will begin fading out. So that's sort of the quick version of the outlook for the year, but today I don't have a specific bias. For the next few weeks, I remain bearish. I think the ECB will hurt the euro in the January 21st decision. A question from Ryan, what app are you using for support and resistance? I'm using TradingView, available for public use. Yes, it is. Does it automatically draw the support and resistance line? No. Well, maybe there is such a feature in TradingView, but I don't use it. I just use, I put the lines on manually. Okay? I can show you how it's done, but it's quite simple. You can see here on the left-hand side of the screen, you can just pick your lines here. You can just pick horizontal line and place it. Okay. Maybe they have a feature of automatic lines. I'm not aware of that. Okay, any more questions? Yeah. Question on pound dollar short or long if PMI disappoints today. I'm not sure that, well, no, we're back in the middle of the range. So I would say a good figure is positive for the pound, bad figure is bad for the pound, because we're sort of in the middle of the range sometimes, but look for the movement. Sorry, let me correct one small thing. Look for the movements just before the release. Okay, it's released at 9:30 GMT, just under an hour from now. Look at the movements in the 15 minutes towards the publication. If we have pound dollar, let's say, strengthening before the release, that means there may be some leak or some expectations that the figure will be good. So if the figure is indeed better than expected, don't expect it to extend the rise, okay? That means it's already priced in, all right? Or if it falls before the release, don't expect it to extend the falls if the figure is negative. If let's say pound dollar begins rising, and then we have a negative figure, then you can expect a big fall. Or if pound dollar begins falling, and then we have a positive figure, then we can expect a big bounce, because these kind of leaks or this kind of front running releases in the United Kingdom is not uncommon. Let's put it this way. Okay, so if we stay at current levels, we have stable pound dollar ahead of the release. It just depends on the number. Okay, let's look again at what's expecting us. We're already here at the end of the week. So official expectations stand on 52 point. No, we don't have a consensus figure. Anyway, 52.7 was the previous figure, so that's the expectation. Question from Tilan. Dollar yen might have found temporary bottom for this morning. Might, not that it did with certainty. Yeah, talking about might, the the yen has fear of the might of the Bank of Japan. Currently, yeah, we're at a fall of 1.2%. We're at just under 119, 118.70 is the low level for now. I'm marked support at 118.20, so I'm not sure where we've seen the bottom quite yet. But we did fall below another support line, weak support of 119.20. Let's see how things stabilize. Remember, liquidity is back to business. Markets are reacting to all the news over the weekend. I'm not sure it found support quite yet. I think that once it falls to 117 or to 115, then the Bank of Japan might begin making noise. But so far, I'm not sure it reached the bottom for today. Okay. Any more questions? Anyway, as we talked about earlier, one of the big movers, well, actually the move began late in 2015, around the holidays. It was one of the only currency pairs, the crosses, that began moving. Most currency pairs were quite stable around the holidays, were sleepy, but pound yen did move. We did see weakening in the pound, strengthening in the yen, and the result was a significant slide in pound yen, which today turns into a good fall, a big fall. Okay, 175 is support because it was support back in April 2015. Okay, let's take a look at oil. So oil, WTI crude oil, had a very exciting end to 2015 in December. It fell to lower ground. We had expectations for Iran coming back online. OPEC deciding, well, not to decide anything anyway. The members of OPEC are not in agreement one with each other. And of course, Russia continues pumping. The United States shale industry did take a hit, but continues pumping out oil. In general, too much supply, not enough demand. Higher demand maybe from India, but lower from China, and not enough growth in demand from other countries. Of course, cheap oil will eventually result in more demand, and things could change, but at the moment oil is depressed. We reached the 34 handle, 34.25. Since then, we did have some kind of recovery. I don't think this recovery is justified because oil inventories continue rising. We'll have the weekly release from the EIA on Wednesday, but these tensions in the Middle East sent the pair once again to the August low of 37.73, and which, well, some kind of resistance there on 38, and now we're back down a bit. Let's see where oil prices go. I think it'll have a significant impact on the world. Also, in 2016, just a year and a half ago, oil prices were at around 100. Okay, and yeah, so the big fall in November 2014, then some found the bottom here, even traded during the summer on higher ground around 60, but then another fall, more stability, and another fall. The moves already are not as dramatic as they were in early 2015, but the impact of an ongoing low price of oil is certainly felt all over the world. It's part of the conflict now between Iran and Saudi Arabia. Okay? Any more questions, or we'll move to the wrap-up for today? Euro dollar in range. Okay. So I guess it's time for the wrap-up for today. The first wrap-up of 2016. Oh, for the wrap-up, we have a question from Jax. What pairs to watch today? Well, first and foremost, euro dollar, because we have German CPI and we have the safe haven flows and the SM manufacturing PMI, and pound dollar because of the fall in the pound and the manufacturing PMI in both countries, actually, in the United States and the United Kingdom. Let's see another currency pair to watch. Let's see if you follow the story with Iran and Saudi Arabia. Let's see if oil prices continue falling. After they jumped higher, they began falling, and let's see how dollar CAD. Basically, I could name almost all currencies because we are seeing very nice movements to start the year. So if it's the Canadian dollar because of oil, if it's the Aussie dollar because of China, if it's safe haven flows in euro yen, and all the crosses related. So it's not only about figures. I'm not sure I answered your question, but so many currency pairs to watch. I would focus on euro dollar, but it's really, we have news coming out from all over the world impacting all currencies. Okay. So this is the wrap up for the live market open on January 4th, 2016. Make sure I won't confuse. We're already 2016, the first show of the new year. We had an exciting end to the year and exciting weekend. Figures in the United States were a bit disappointing, but we didn't hear any new hymns from the Fed. The big news over the weekend came from the Middle East, Iran-Saudi Arabia clash. The Saudis executed a Shiite cleric, an opponent of the regime in Saudi Arabia, and the Iranians didn't like it. This followed, the relations now are bad. This has an impact on oil prices, and this has an impact, sort of worries all over the world. This was exacerbated by news coming out from China. A miss on Chinese manufacturing PMI with 48.2. Another devaluation of the Chinese yuan means more currency wars, and stock markets in Asia reacted with a big slide. Also in Europe, we're seeing more of the same. This risk-off atmosphere means a stronger euro and yen because of safe haven flows. The yen has always been a safe haven, and the euro, it's relatively new. It's something of the past year or so. Euro dollar 109.25 on the higher range, 109.50, 110, 110.70. To the upside, 108.80, 108 to the downside. Dollar yen, big fall to start the new year. Currently around 119. Maybe it did find the bottom as we talked before, but maybe not. 118.20 is the next support I see. 120 is resistance. Pound dollar had a nice slide towards the end of 2015 and began the new year with a gap, a dip under 147. And basically, no rate hike is expected from the UK. Soon we'll have figures. We'll talk about that. Dollar CAD in range, still shy of 140. The line it sort of looked above late in 2015. 137.87 is support, 140 resistance. Oil prices began the week higher, the year higher because of tensions, but they might slide once again. I am bearish on oil. Aussie dollar, risk off, worries about China, currently 72.20, which is the battle line. Lines to watch 72.80 and 73.60 to the downside, 71.50 and 70.60. Kiwi dollar had a nice finish to 2015, got closer to the resistance at 69, but this risk-off atmosphere sent it down to 67.65, support at 67, resistance 67.90. Okay, Events for today are all around PMIs. Finally, Eurozone PMIs are not expected to have an impact. Manufacturing PMI in the UK is important. As in many developed economies, manufacturing is the weaker link. Let's see if the UK falls into contraction in this sector or not. Not so sure, but anyway, it's the weaker figure. Also today, German CPI feeds into the more important all Eurozone PMI. CPI, inflation numbers, which is of course important input for the ECB. So we have German states releasing these figures during the morning and the final figure at 1 GMT. Let's see if we have another figure out from, no, we don't have it, from the German states. And the big event for today, the first hint for the non-farm payrolls, we have the ISM manufacturing PMI in the United States. It was in contraction zone in November. Let's see if in December we have a small improvement, and also look for the employment component for a hint towards the non-farm payrolls. Before we go, I see we have more questions. Yeah, you're welcome for naming them all. It'll keep me busy, keep you busy. Yeah, they suspended trading in China for now, over 5% drop in stock market. Yeah, maybe I didn't mention that early in the show, but thanks for bringing that up. Chinese yuan devaluation plus the weak PMI resulted in another crash in Chinese stock markets, and they suspended trading over there, and it's still closed. So this, of course, means a dark cloud on all European stock markets, and later on the US stock markets. Okay, so bad mood to start the year in stock markets, which means big moves in currencies, stronger safe haven currencies, weaker commodity currencies, and a weaker pound as well. Okay, so that's it for today. I wish everybody a happy new year, a successful and safe trading day, a successful week. The show is back to business, no more vacations. Specifically on Wednesday, we'll have a 2016 outlook. Okay, so we'll have a shorter version of the show, and we'll have a bigger segment of this show focusing on 2016, of course, with your questions as well. Okay, so that's it for today. Thank you and bye-bye.